Hey, welcome back. Dave Dubeau here. And today we're going to be talking about the best way for you to raise capital for your real estate deals, because running out of capital is the biggest challenge most real estate investors have when they want to scale their portfolio. So in this video, we're going to look at 6 different ways to raise capital, all the way from finding joint venture partners, traditional financing, crowdfunding, and 3 other exciting ways as well. So stay tuned. All right, so when it comes to raising capital, what most people think of when they're first getting started is traditional financing. So you, as the real estate investor, you come up with the money that's required for the down payment, closing costs, renovations, etc., and then you get financing for the rest of the cost of the property from a traditional lender, usually a big bank. All right, so that's the traditional way, and it's a really good way to get started. In fact, traditional financing is fantastic for most deals, because if you're getting loans, if you're getting mortgages with the big banks, that tends to be the cheapest money available out there. So wherever possible, you do want to get and do traditional financing. The challenge comes with what happens when you run out of money and or credit for those down payments. That's where things get a little bit dicey. So that might be where you have to look at other kinds of financing. A second way of getting financing for your properties is to actually get the financing from the seller financing deals. So back in the day when I was first getting involved in real estate investing, I did a lot of creative low money, no money down type deals. And seller financing was a wonderful way to get into a property without having to come up with much cash or credit on your part. The challenge is these kind of deals are few and far between. The statistics I've seen is there are about 1/3 of the properties out there are owned free and clear. So that's great. That's quite a few properties. However, those sellers, the sellers of free and clear properties, typically want to get all of their cash in one big chunk up front. They usually don't want to get paid out over time. So coming up with these seller financing type deals is possible. Lots of people do it, but it's not super common. And my big challenge was when I was doing those kind of deals is I actually, because I only focused on that, I let a lot of really, really good deals slide by because I didn't have the capital, I didn't have the money, I didn't have the financing set up to buy those properties outright. I would have been able to do a lot more deals if I had access to the capital. So another way to get capital for your deals is through crowdfunding. And crowdfunding is something that's become quite popular these days. And that's where you can literally get tens, hundreds, thousands of people together putting up a relatively small amount of money each to finance your deal. So people say, well, there's lots of big benefits to doing that kind of stuff. I get 1,000 people on board. Each one of those people brings in, $500 and there's $500,000 right off the get-go. Well, yes and no. The big challenges with crowdfunding are finding the crowd to fund your deal and then making sure that you're keeping everybody happy. Because imagine if you bring on 20, 30, 40, 50 investors to crowdfund your deal with little dribs and drabs of cash each, now you've got 30, 40, 50, 100 people that you have to answer to. And that can become a real logistical nightmare. So be careful when it comes to crowdfunding. Another source of funding is doing joint venture partnerships. So this is where you bring the deal to the table, you bring the expertise, you bring the team, and you bring on somebody else who has the capital and maybe the credit to actually get the deal done. And then you join forces and you share in the rewards and you share in the risks of that property. So this is a fantastic way to get started when it comes to using other people's money for your deals, is to bring on a joint venture partner. One of the things I love about bringing on joint venture partners is not only does it allow you to scale, not only does it allow you to do either more deals of the kind of deals that you're doing or start getting into bigger, better deals if that's what you want to do, but it also lowers your risk. How does it do that? Because when you bring on a joint venture partner, that person is going to share in the rewards as well as the risks of that property. So for example, here's a great example. If you are doing a BRRRR type of deal, so you need to buy the property, renovate the property, get it rented out, get it turned around, chances are it's going to be several months. It could be 3, 4, 5, 6 months before anybody's seeing any kind of cash flow on that property. Now, the good thing about bringing a joint venture partner on board in that case is that person is not getting, nor are they expecting any kind of return on their investment until the deal is up and going and profitable. Does that make sense? So that lowers your risk because you don't have to be coming out of pocket every single month to pay that partner. All right, so that is a wonderful benefit of joint venture partnerships. Another option is bringing on private investors. So what's the difference between a private investor and a joint venture partner? Well, a private investor is typically coming on just for a return on their investment. So what I've seen quite often with smaller type deals is, let's say you get the deal going. Let's use that Burr example. Let's say you had the money to come up with the down payment and the renovation costs and all that kind of stuff for that deal, and you got it all done, and you got it up and going, and you still had a bunch of equity left in that property, and you wanted to get access to that. In this case, you could bring on a private investor after the fact. They could do something like a second mortgage on that property. And let's say, for easy numbers, let's say you've got $100,000 equity in there. They could do a second mortgage on the property for $100,000. You get your money out, and you're just paying them a fixed return on their money. They're not a direct owner in that deal. They're not getting an equity stake in that deal. They are assured, their investment is assured by the mortgage, but they're getting a fixed return on their investment. So that's a great example of bringing on a private investor. So if you're looking for the best way to raise capital for your deals, I personally think the best way to get started with is with joint venture partnerships or with private investors. And if you want either one of those, I've got the solution for you. It's called my Money Partner Formula. This is a proven process for you to be able to attract investors to you instead of chasing after them. So you don't have to worry about dialing people up, cold calling, dialing for dollars, networking, schmoozing, none of that yucky stuff. You don't have to worry about selling people on your deals or convincing people to invest with you. This is all about attracting investors to you instead of you chasing after them. And even if you're starting from scratch, this is a proven process that's going to allow you to raise your first 6 figures in a matter of weeks and even 7 figures in a matter of months. And guess what? The price is right. This is a free book. You can get a copy by clicking on the link in the description below, or just head on over to investorattractionbook.com and get your copy today.